So those of you that are, maybe this is your first time with an AZREIA meeting, so let me give you a brief idea about the market update. We like our members to use this information in their investing. They use it to find money. They use it to find partners. They use it to find deals. They use it certainly in their negotiations. It's best if you know a lot about the market where others don't. That certainly gives you the upper hand when you are negotiating with folks. Remember, you always want to make the deal fair. It always needs to be legal, ethical, and moral. But if you are armed with more information, that is a very, very good thing for you. I will go through these charts at some speed, so if you've never attended a meeting or gone through this market update before, we don't intend for you to get your hands wrapped around your head, wrapped around everything we're going to talk about tonight. Over time and coming to the meetings and seeing the market update, it will make more and more sense to you. So it is time to get started. Here's the disclaimer I mentioned earlier. This tells us that everybody will do their own due diligence and we can talk freely and share opinions, because most of what you're going to hear for the next 30 minutes or so will be my opinion on the market as well. So please be prepared to do your own due diligence. Just because I say it doesn't necessarily make it true, so please check it out. We have a very, very interesting market right now, and we're going to get into it as soon as I tell you a little bit about some of our business associates that are very important to AZREIA and to our members. They're a great source of education for you and, of course, for services and products that they offer. So a Great American Title, most of you, if you've been a member for any length of time, Mary's been around us for over 10 years, 13 years actually, provide great service, all creative transactions they can close. So give her a call. We like our investors to work with the people that we suggest that they work with, regardless of the company they are with. We got JP Dada at Vantage and Nicole Wolf that's at all of our meetings, self-directed retirement plans. We fully believe that every real estate investor should be investing through a self-directed retirement plan. My plan is with Vantage as well, so that's something you need to consider is working. You need a self-directed retirement plan if you don't have one, and Vantage is a great company. Jill Bright at Chicago Title, another excellent source of information between Jill and Diana Jackman, who does a lot of the work getting all our deals closed. They are exceptional people to work with, just like Mary Sarah is over at Great American Title. So we have two outstanding title agencies, but it's the people within them. So you need to get to know these guys and use their services. They are phenomenal. And Mark Steinbeck, it's been Merchants Funding to me. It's Merchants Mortgage and Trust Company now. I've known them for 13 years. Mark's been a member since day one, offering fix and flip loans to our members as their primary product. I know they have other products as well, but it's a great source of loans for private money. And here's the rest of our business associates that are currently supporting us in our trade show. So all of these guys can provide just exceptional services and support for you, and I encourage you all to get to know these guys, these businesses and the people in them. And briefly on Home Depot, because there's going to be another rebate check or gift card coming out to most of our members here. Last time 610 members received rebates or gift cards, and last year over $500,000 went back out to our members. So more checks and gift cards should be coming out in the early August time frame. But what I really wanted to tell you about was at our August meeting, you will want to be there. We will be announcing two new Home Depot programs. First, the appliance program, and second, a paint program. Now, what makes this significant is in both cases, these are now what I would refer to as price programs. The rebate program has been great with the 2%, and so much money is coming back to our members. That's terrific. But we've done so well with this program across the country, where now we'll be announcing two new ones. And the appliance program is phenomenal, and the paint program is too. So we'll give you all the details. These will take effect in August, so don't miss the August meeting. The Phoenix Real Estate Club next meets August 25th, and we'll be doing all of our great results-oriented networking, plus a discussion on the market and other topics as well. And the AZREIA meeting is August 10th back at the Celebrity. Two great topics, fair housing and premises liability, that we'll be covering. We haven't covered these in a couple of years, and they're always important. It always generates a lot of discussion. Mark Zinman will be helping with these presentations, and he's an excellent source, being a landlord-tenant expert and an attorney. to present this information. So I'm also going to be announcing in August what we're going to be doing at our September meeting, and I couldn't be more excited. I got something different and something unique with one of the titans of our industry that I want to be telling you guys about coming up in September. So we got several good meetings in a row coming up, so I encourage you to be out at the Celebrity Theater or out at Tucson and Prescott over the next few months. And I hope most of you, if you subscribe to our Phoenix meeting, our Tucson meeting, or our PREC meeting for text messages, you would have received a message about today's meeting. I always encourage all of our members to be sure they receive text on property postings, so you would text property post to 71441, so when any new wholesale deal comes out, you're notified of it immediately. All right, let's get to the market update. Let me check my time, how we're doing. We're doing really well. So new homes is where we start. And this is across the country, it's new homes across the U.S. And we're up 17% over what we were a year ago. So we have seen, if you look at my cursor when it comes up here, we have seen over the last several months, we have seen slow growth in this area. And we're starting to inch up closer to what's considered healthy. So 536,000 versus a healthy market, which is considered at 700,000. Great up, and we're seeing also the inventory level remain very, very consistent over this period of time as sales grow. So we're starting to see a little momentum U.S.-wide here, still 164,000 away on an annual basis from getting back to healthy. But we have moved a long way here, and that's good to see, but a long way to go. So if you look at Maricopa County new home sales, this past month we were about 950. You can see it here. Now our average is almost 2,700. So we are nowhere near where we need to be relative with new home sales. And this is single family and condo. However, this is our highest sales rate that we have seen for the month of June in several years, and so at least it is moving in the right direction. Now we'll probably see a little bit of seasonality in these numbers and see it start to flatten out here over the next few months. But if you look year to date where we are, we're up 6% over last year, but we should be running around 15,000 units, and we're running 4,350 units, which is anemic compared to where our market needs to be in support of new homes. So a very, very long way to go here. Our new home market is not recovering anywhere near rate and pace as it is across the rest of the United States. So a long, long way to go. Now, I normally don't show this chart, but I wanted to show it today. I show this chart once every 4, 5, 6 months or so. This is new home sales versus price. And this goes back to 1999 and tracks it all the way through, actually all the way through June. And the red line is price. And this line just gives you an indication of, you know what, if all things stayed normal, we should be at around $250,000 worth of our new home price rather than north of $300,000. So I want you to look at a couple other things on this chart. This is back in the bubbles. See the steepnesses of rise in price. And that is what we have seen, almost a mirror image of that between 2012 and 2013, and then price has flattened out. Now, a lot of this price difference between here and here has to do with the size of the home being built. They're several hundred square feet larger. But what this has done is this has taken, with this being the median sale price of a new home, this has moved it out of reach of the many or most, all first-time buyers. And this is what's having a big impact on our new home sales in this market. So that means that we're running 10% of our market as new home sales, where we should be running somewhere in the neighborhood of 35 to 25% being new homes if you look historically. So resales running at 90% now rather than its traditional 70, 75% or so. So let's look at housing starts across the U.S. The 54-year averages are the blue line and the red line. So when we look at single family, 680,000 housing starts for May, well below, as you can see, what our 54-year average would be of over a million units. But you look at apartments, that's in the red. And although we were slightly below our 54-year average in May, we had been above it a few times over the last several months. So apartments have certainly recovered much faster than single family on the housing start side. And although we've seen this growth here, we have a long ways to go to get back to anything that would be considered normal. And so look at Phoenix now on our housing starts. So where are we, especially compared with the rest of the country? This red line is drawn just at our 1990 bottom of that recessionary period, so we can see where we are and where we've come up. This is the bottom from the last recessionary period. That's the end right here of when the recession ended. So we see we did 1,591 units, which was up 44% over 2014. We're up 30 over, I should say, that should be up over April. So housing starts in Phoenix are up 30% year to date. Now the interesting thing here at 1,600 units, our average back at the beginning of the last decade was over 3,300 units, which is the last time we saw a market that we would want to compare to. So we're not even half of where we need to be to get back to that time period. Okay, building permits. To me, this is always interesting. I did a couple other things here. This is U.S. building permits. Single family are up 9% year to date. Multifamily is up 16% year to date. So total, interesting, we were running 93% of our total average. Single family is only running 68% of average. So I went back and did some research. It's only running 91% of what it was in May of 1960. So let me just let that sink in for a second. May of 1960, 91% of that number. Now we look at apartments, it's running 182% of average and 241% of what it was back in May of 1960. And then moving on to Arizona building permits, you can see here's we are for May this year, and here's we are May last year. So a significant increase year to date even. It's up 21% in single family and 19% for multifamily. And drilling down even further into Maricopa County, it went down slightly from last month, but 1,362 permits on a year-to-date basis. That's up 33% year over year, but still anemic. 1,300 permits. We're going to see more sales because of the more permits have been pulled. So our 950 sales that I showed you earlier in the presentation, hopefully those numbers will be going up based on the permits that are being pulled as we look out next few months from now. All right, so let's look at existing sales, resales. This is across the U.S. And the interesting thing about this chart, you can see where we are in May versus May last year when you look at the red circles. But more importantly, if you look, every month of this year is significantly better than every month of last year. And although these are seasonally adjusted annual rates, that is a significant improvement as you look across the U.S. Now, if we get into Greater Phoenix, now this was interesting. Now, at the Celebrity Theater last month, I told you that our sales were going to be flat. I actually kind of kidded around and said, I'm pretty sure sales are going to be flat. They may be up a little or they may be down a little, so I knew I'd be 100% right. Well, what happened here, sales were, in a word, a lot better than what we thought. And it's interesting that they were. Now, one of the reasons for that, and actually one of the primary reasons for that, is that there's one extra day for sales to close in June, which I should have taken into account and didn't. And that would account for the majority of that uptick, and it only would have been slightly an uptick had we not had that extra day. So if you look at sales closed on an average daily basis, May and June were pretty close. However, we are growing, as you can see. Sales to date, Greater Phoenix, in single family up 11%, and condos up 4% over last year. Rarely show this chart. I just thought it'd be a good time to do this. When you see a black line on a chart, everything left of that black line are annual numbers. So that's 2003, 2004, up through 2014. And everything left of that would be monthly numbers. And I have all of 2014 here in the 4 months that we have full data for, because the national data is significantly behind the current data. And this is cash sales. percentage of sales that are cash sales, comparing Maricopa County to national. And we've been mirroring them now for the last several months. But it still goes to show you 1/4 basically of all sales are still cash. And we know that's because there's a lot of things going on relative to people not being able to qualify for loans, tight money supply, and so forth. So a significant cash is king marketplace still exists. Okay, so let's look at sales pending. This is this green line. The black line is the actual sales. So our pending slid down a little bit 2 months ago. We thought, sales would kind of stay kind of even, and then they ticked up. Well, look what has happened with our pendings, which is normal this time of year coming out of the spring selling season, right? So pendings are starting to come down. With pendings coming down, I can pretty much, bet my reputation that this number is coming down significantly as we go forward next month. It was hard with 2 months of down pending for sales numbers to continue to go up. This is more of an anomaly than how I explained it just a few minutes ago. So I do expect we're going to see sales coming down. Now I took this snapshot, this is probably somewhere around July 5th when I took this snapshot of single family owner-to-owner sales in the price range that a lot of investors work in. So for the month of June, 67% of sales were in this price range. We had 4,341 new listings, 242 expired listings, 529 canceled listings, which gave us a net new listing of 3,570, or we only added 0.8 months of inventory based on a current sales rate. So overall active listings would be right around 5,600, 5,700 units, or 1.3 months of inventory. But remember, sales will probably be slowing in July. So our months of inventory, because it's off of a sales rate, we actually have a little bit more than it appears when you factor in a slowing type of sales action that's going to be happening. But still, that inventory is very low, excuse me. So I took a look at pendings in that same price range. And we're down here. You can see the number there. It's blacked out on my screen. I can't quite see it, but a little over 3,200 units, maybe 3,300. So we see those pendings have continued to drop. And I put this chart together for the first time because I wanted you to see something in the price range of 100 to 150,000. From what's been going on for the last couple of months, you can see how far the normal listings have been dropping off. And then that's from June 4th. So a month later, what has happened, you can see there's the drop-off, and now the listings are starting to flatten out. It's the first time we've seen them starting to flatten. If we take this up a notch to the $150,000 to $200,000 range, here's what was happening in June. You can still see that falling off of the listings. And then you see as we exit the end of the month and coming into the July 4th holiday, these have also flattened out. So we've that slide has stopped relative to the number of listings that are out there in two primary price categories. Okay, so let's look at fix and flips. We have data now through April, and we are down 12% year to date over where we were for 2014. We're kind of settling in the high 300s as the number of fix and flip volume that we're seeing during each month, which would historically be pretty much in the right place. And I started looking to try to find out how are we comparing to the rest of the country. And I showed this chart last month at the AZREIA meeting, and I wanted to show it again this month. And we only have data through April broken out for fix and flip. And although this is first quarter information for the rest of the country from RealtyTrack, where 4% of sales are fix and flips across the country. And RealtyTrack tracks these as anything that sells within a 12-month time period. So they have a very liberal definition of fix and flip. We track whatever sells within a 6-month time period as a fix and flip in Maricopa County. And when I say we, that's actually done by the InfoMarket and by Mike Orr at ASU and Cromford Report that does that tracking. But even using the definition even being a little bit different, I believe if RealtyTrack's definition was ours, then their number would be a different number than what it is, probably even lower than 4%. So Maricopa County those of you doing fix and flips there, we are still running way ahead on a percentage basis of the number of fix and flip share in our market as a percentage of our entire market. And now that I have two data points here, as we get to the third data point, I'll start plotting a trend graph so we can start tracking this as well. And Realty Track's information for second quarter will be coming out the next 45 days or so, I hope, and we can compare that as well. So our fix and flip volume, whereas it's down a lot because we cleaned up our inventory of distressed property so much, we still have a lot of fix and flip volume when you compare it to the rest of the country. So let's look at our volume. This is normal sales, so owner-to-owner sales. This is for the month of June only for the last 15 years. And we are seeing, as you can see here, significant growth in the volume, especially over 2014 for this month. So all this is good. This is what we expected. We're continuing to see distressed sales down as well. That's what they were over last June. And this is the rate of decline, as you can see, has slowed quite a bit. And we've actually seen a little bit of uptick on short sales and a lot less on the REO side. So as we look at each of the price ranges, our under 100,000 market continues to go down. That momentum slowed just a little bit. We expect this is a dying price range. We expect this to continue to go down, although we do expect it will flatten somewhat, but will continue to drift down over time. Same thing with the 100 to 150,000 price range. That has continued down. This is June 2015, 2014, 2013. So that's continued down. We're going to see that continue down at a slow pace as well. We'll have some months where it ticks up, but overall the trend will be down as far as volume in this price range. 150 to 200K is a growing price range for volume, and we are really starting to see this here. When that volume jumps up by about 300 units, that's a darn good increase over what it was last year. And so this is a growing segment of our market and will continue so. And as we go up the price ranges, you will see that. So in the 200 to 300,000 range, we've seen another 400 unit increase in that price range alone over last June. In 300 to 600, we've got, although that's a much wider price range, the growth that we've seen there is a little over 500 units that we've seen. So that's also very, very good growth in those ranges. So this chart is one I put together to have a little bit of a discussion with you. So these are single family sales, normal sales, owner to owner, and we're looking at it for the month of June, and we're looking at it by price range. So here, when I was talking about the charts just a minute ago, these are in $50,000 increments, so a little bit different than what we were just looking at. So volume's down in this price range, down, and we're projecting it to continue down in this price range. So when you get to 150K, we are seeing significant increases in each of these. So this is up 25% over last year, basically 30% and 32%. So what does this mean? Well, especially if you're fix and flipping, to me what this means is very simple. Before, where you were working, trying to buy under 100,000, many of you, and then sell, around 100 to 150,000. With those two areas declining, you were finding less product to source and fewer people to buy. And over time, that is going to become a harder and harder and harder thing to do. Acquiring here to fix it up, you're going to need to be selling it in here or here. So fewer and fewer opportunities are going to be available here over time. But still, acquiring here and selling into a price range where volume is increasing is a very, very good thing. And also, when we say you got to start looking in this price range to fix and flip it and move it up and sell it into these price ranges, these are growing price ranges. So as a fix and flipper, we do have good market here, but you have to look at where you're playing and how and what's going to be happening over the long term to be sure you start making really good decisions. So not saying don't participate here and here. Certainly you should if you can find them, but this is going to be harder and harder. Where it's going from here to here is easier, and here to these is even easier. So it's hard when I'm not up on a stage and I can't get your feedback, read your body language a little bit to see if I'm connecting. It's very, very difficult for me to be sitting here just staring at my computer screen and not being able to see you and understand if I'm connecting. But I hope I'm making sense with this one, because I think it's very, very important. This, to me, indicates a very strong fix and flip market over a period of time, just a solid market. And where it's weaker, you know it's weaker. You can continue to participate there, but know you're going to be sliding up that price scale. And there's support for that price scale as you move up. Sales to landlords, 12% of volume went to landlords overall. That's for both single family and condo. Nearly 1,200 units were bought as rental property through MLS. Condos, 1 out of every 5 condos is going into the rental pool, and about 1 out of every 10 single family homes is going into the rental pool. Now this is an important chart. We track the median lease rate just to see where our market is going all the time, as well as days on market. Our rental market continues to be extremely strong, and we're seeing the prices go up, which is very, very important to what has to accomplish over time, as our market is a much more normal market these days. So we expect June and the summer months to be our highest prices for rents, and this year is not letting us down at all. You can see where we were last year. That was highest during the year. They were highest during the year in 2013, highest, over the summer, June, July, August, in 2012 as well, and I didn't start tracking this until 2011. The other important thing of how strong our rental market is days on market. So June is always one of our lowest days on market, and this did not disappoint this year, but 25, as you can see, is our lowest days on market since I've been tracking this. So you can see very, very strong rental market. That low days on market, I know it's difficult to push your prices up because you don't want to have vacancies for one more month, but now is the time to be, asking as much as you feel you can ask for those rental properties. Now, these charts I've sourced from TCT Property Management Services, and they get their data from Cromford and Associates and Tina Tambora, like I get a lot of my data as well. And they've already done these charts. I want to give them full attribution for them. And these are excellent. These are on their website. You can go to their website and you can play with these charts, and it is exceptional. But I went down and just kind of limited these to 3 or 4 bedroom unfurnished, which is a lot of what is a sweet spot of our market. And this is by square footage. So this is asking rents of dollars per square foot, and it does show inventory. So from 1,000 square feet up to 2,500 square feet. And you can see, and this is just single family, 3 and 4 bedrooms unfurnished. So you can see where our inventory is, and you can see the price per square foot that it's happening across those. So it comes down, the price per square foot that you're getting comes down the larger the home happens to be. Now, if we look at it per bedroom, we have 848, when I pulled this chart on July 9th, 848 3-bedroom properties in the rental pool on MLS, which is only a fraction of our rental pool. But you can see it's averaging $466 per bedroom for a 3-bedroom, only $373 per bedroom for a 4-bedroom, and over $600 for the 79 2-bedroom properties that are available on MLS. And one other thing, you look at the style or the type of property relative to the asking rents. And here's single family, 81 cents a foot. And I got to tell you, in my estimation, we've got to, over time, over an extended period of time, get this up to around $1 a foot. We continue to talk month after month here for the last several months about how important it is that a business case has to stay together for real estate investors to be able to purchase additional rental property, carry debt service on that property, and have that property cash flow effectively for it to be a good, solid business decision to contribute to the rental housing supply that's out there in the market, in this strong a market. And it's difficult to do it, in my mind, right now at these price points. Not impossible, just difficult. So with our distressed market gone, we need to be here in doing these things. So continue to look at this and continue to see when you can push your rents up. We do know that there's an issue with earnings not growing as fast in this country, actually maybe even shrinking, which makes it harder and harder for potential residents to be able to afford the rent. My position is we need to be sure that we provide housing. So we cannot fix the earnings part of this. We have to only fix, and we can only work on what makes it a good business case for rental property owners, and the earnings piece of it is going to have to be solved by others because we can have no impact there. Let me get into pricing. I know we have about 10 minutes left. I'm going to tell you right now I probably won't finish in 10 minutes. I'll run slightly over that. Our price jumped up to $229,000. This market can support more than that, but that's still significant price increase on the median sale price. But the price per square foot, as we projected, did drop down slightly, not much, $136 a foot, and I certainly believe our market can support somewhere around $150 a foot. Okay, now, by price range, 61% of our market is now over $200,000. Again, that gives you an idea of where we are relative to what you can do if you fix and flip. It also gives you an idea as rental property supply costs go up, acquisition costs go up into higher price ranges, what that has to mean for rents. Okay, this you can see here how the price has been drifting up all year, and you can see how we slightly dip down. On an annual appreciation basis, we were just under 5% for the month. So very good, solid appreciation. We are expecting to continue for the next several months. It's just gonna jump around only slightly. Anything plus or minus 5%, or really plus or minus 3 to 4% is a very, very good thing. I thought you might want to see this. I pulled this out of Mike Orr's report from ASU. And this takes a look at the percent change in the annual dollars per square foot. For these are the 15 top ones, are the ones that I pulled, so you can see the areas where you invest. Important to note here is Phoenix, which was at 8%, and they currently have $128 a foot annual. Okay, so as we look at the different price ranges here, here's overall, there's 136 you saw. It's actually down to the penny was $136.44. I would like to see us as we exit this year somewhere around $137.53 as a target. We did jump up a little bit the first few days in July, but that's nothing to be concerned about. We still got a little ways to go. That percentage, I see that's off, that's wrong. We got a little growth between those two, but prices are probably going to be flattening out a little bit here and going down ever so slightly, if at all, but it won't be pushing up very much. The tendency is for prices to stay the same or go down. Under 100, we're getting close to that $70 a foot, which is kind of where that price range needs to be. I did do 100 to 150K. That's about $89 a foot. We have 7 to 8% growth to get to this target as well. And so between 100 and 150K, 150 to 200K, we're a little bit over $100. It barely dropped down. Got a target price here. I'd like to see this price range in at some point in time in the future at about 116. At 2 to 300, we're at $122 a foot. I'd like to see this around $132 a foot. So we got about 8% to go there as well. And 3 to 400K, we dropped down a little bit. I'd like to see us around $146 a foot over time. 400 to $1 million of prices are still over the long haul going up, although they have started to flatten. So the luxury market continues to be strong from a price standpoint. Even the ultra luxury market over $1 million is doing very, very well. Normal sales, owner to owner, $138.61 a foot. I'd like to see us get to around $144. We're probably not going to do this year. This would be where we should end if all things were on a straight line basis, linear basis, based on our compounded annual growth rate that's average to us. So it's going to be a struggle for us to get there this year, but pricing is going to be pretty stable. I got handed a note. I'm not sure if we're going to turn off in an hour here or not, so I'm going to keep going. I think we're going to be able to run over. I want to get through the entire market update. My staff will let me know if for some reason we get cut off. I don't think we will. What I look at from a pricing standpoint is this is the pendings over the last month or so, and it's very, very flat, starting to trend down towards the end of June and as we go into July. And that's why I'm saying our price is going to hold pretty much steady. Might go drift down a little bit, but there's not going to be much movement at all relative to the price standpoint. Our list price per square foot last 2 or 3 weeks, we're starting to see that drift down as well. That's just another indicator as we come out of the spring selling season that we normally see a little bit of a downturn in price. I ran across this from CoreLogic, and they say that across the U.S., our housing prices are fine. You know, we're a good 4 to 5% below before we would get into anything unstable, which would be above 10%, and how they calculate this relative to pricing in the market. So across the country, pricing is fine. There's nothing going on there. However, in Texas, they got a few communities like Austin and Dallas, San Antonio, Houston as well that they think are in a very, very difficult position and are overvalued. Negative equity share. Here in Arizona, we're still running about 17% negative equity share. Why is this important to us? Well, this could be an indicator of a continuing reasonable short sale market for those of you that are working short sales as well. So we continue to see our REOs go down. And this doesn't mean that they're in foreclosure. This just means that they're underwater. So let's look at inventory really quick. Our inventory is running substantially below on a months of supply basis to what it is on a national basis. In months of supply, if you look at single-family normal listings, we're at 2.1 months as we exit May, and we stayed there in June. For distressed single-family, 1.5, just ticked down slightly from May. Single-family REO inventory held steady at 1.5 months. And short sales, excluding under contract but accepting back orders, also stayed at 1.7 months. But there's new short sale listings coming on in price ranges that are attractive to investors. We had 236 new short sale listings come on under $250,000. We had 171 REO listings come on under $250,000. We have 443 short sales that do not have an offer on them in MLS. So there's opportunity there. New listings by month, we had 7,000 that came in. Our listings are very low. We're still not enough people putting their homes on the market. When I looked at new listings just month to date for the first few days of the month, I did this on 4th of July, between 75 and 250K, they're actually down year over year. So we're not, continue not to have the listings come on that we need to support what's going on in the market. So a buyer's or seller's market, let's look at this. Well, we know it's a seller's market. Look here, how much stronger our seller's market is during this spring selling season. Very, very weak kind of seller's market last year's selling season. But by price range, this is amazing. Where your sweet spot of the market is here, we're running 90% almost between 125 and 150K. That's just 9 out of every 10 homes that are listed sell in that price range. 3/4 of them sell. So we have the strong price market, seller's market in these price ranges. And so if you look across all the price ranges, we have a seller's market up to $350,000. We have a weak seller's market up to $500,000. It's still a buyer's market as you get into the more of the luxury home market. So you ought to be maximizing your prices here and not negotiating very much on your prices because of the strong market we're in. And our market index indicates it's a strong seller's market well at 143. Low on supply, demand is normal. So a supply that is causing the issues that we have in the market and driving this high seller's market. And well, as these are the top 17 markets that are doing very, very well relative to the market index. So one thing that I wanted you to see is we had 5 cities decline slightly, even though their indexes are very high. We only had 2 cities last month. I don't know if that's a sign of anything, but it's something we're watching. We only have 4 markets that could be classified as being in a buyer's market, and I would tell you that no for Litchfield Park and really no for Casa Grande. They're too close. They're within the margin of error, so to speak. Only Laveen and Maricopa would be buyers markets as a community. And this is a new chart that I saw that I thought was very, very important to us, so I grabbed it. And you're seeing across our market, 26% of all sales end up having a concession, some sort of seller-paid or seller-assisted closing cost. But here is where this is really important, and why is that? Well, let's look. If you look at it by price range, under 200K, 30% of those had concessions for seller-paid or seller-assisted closing costs. Up to 300,000, it was 30%. And you just saw what a huge buyer market. Some of these things, 9 out of 10 houses are selling in some of these price ranges. So there are sellers here are giving away things they do not have to give away. And you as an investor, you need to realize this. If you are in those price ranges, It has to be an extremely good reason that you would want to even listen to having to concede anything on your price. So market distressed. We are seeing about a 7% distress market. All these are normal sales. We're looking at normal sales selling around $140 a foot, and that's our distress pricing for short sales, and $106 for REOs. By community, you can see what the distress sales are. This green line is our overall market average of about 7%, and so you can see the communities that are doing better and the communities that are doing worse. So pick your favorite. Foreclosures. We're doing real well on foreclosures. 640 new notices and 348 actual foreclosure sales. Well below our averages for both of those. I just got thumbs up. We're still going. So I might slow down a little bit here. I started talking fast, trying to beat the clock. Trustee sales to third parties. So investors primarily buying these at the trustee sales. We had 213 last month, a little bit of an uptick, and 56% of everything at auction is going to a third party, not going back to the lender. So it remains a good source of investment property for those of you buying at the auction, not as good as it was. Foreclosure inventory is how Arizona looks across the rest of the country. Here we are right here. Whoop, I'm sorry. Back. Here we are right here. And so as a non-judicial state, there's only, what, 1, 2, 3, 4, 5 that have a lower foreclosure rate than we do. All the foreclosure issues primarily, are in judicial states up here. So our foreclosure market, our inventory is one of the best in the country for a strong housing market, which is helping us. And when I looked at this, I believe this was from Realty Track. I apologize, the source isn't on this chart. I showed this last month as well. It's just important to reiterate it here. If you look at the top 20 national markets, the top 20, and this is April data, we're ranked 17th. In other words, there are 16 of the top 20, 16 major cities that are not as strong from a foreclosure standpoint as we are now. Remember, all those years we were number one. We were the worst. And so we're seeing, it's interesting, 1 out of every 372 homes in Tampa is in foreclosure. 1 out of every 1,627 in Phoenix is in foreclosure. So very, very strong. So conclusions. Our rental market continues to be exceptionally strong. Our fix and flip market, I have extra caution there. That extra caution has been up there for last 2 or 3 months, and the reason that it is that we know that our market with the pricing is going to be flat, and if anything, it may trend down slightly, and I want to emphasize slightly. Pricing is always almost impossible to predict, but all the indicators are that pricing will be ticking down a little bit as we go through the late summer, early fall. And so if you're buying now to fix and flip, you have to be sure you buy this right, because you can't count on any price appreciation at all. If anything, you got to build in that price might tick down. So a good fix and flip market, but just be careful. Wholesaling seems to be picking up a little bit. That's a good sign. We certainly need all the wholesale properties right now that we can find, especially in the lower price ranges. So if you're building wealth, if you're looking for cash flow, if you need income and cash strategies right now, all of those things continue to work well in our market. So we need to enjoy this time. When you have a rental market with increasing rents, a growing rental market as far as housing supply, so you're increasing supply as far as the number of rentals, but the market is absorbing those with ease, and rent rates are going up, and they need to continue to go up. We have a very strong seller's market right now in most of the primary price points. So if you're fixing and flipping, you should not be sitting on the house very long. But realize that sales will be slowing now a little bit as we come out of the spring buying season, so be careful. That is what I brought to share with you relative to the market. I know I'm a couple minutes over, but I don't think I ran over very much, and I apologize if I talked too fast. I want to reemphasize that these charts will be posted for our members, and if you have any difficulty getting these charts off the website, they should be up by Wednesday. Please call our office. We'll be able to email them to you, so you will have them. Use this information in your investing. Make it work, make it work for you. Use it to negotiate with. Use it to find private money with. Make these charts, let these charts work for you. Our next meeting Our August meeting is going to be a great meeting. We're going to focus on rental properties there. We're going to be looking at premises liability and any latest fair housing issues that you need to be aware of, and going to have a couple of great announcements on Home Depot. I want to thank you all for joining us on our first virtual meeting. I hope it worked well. I have no way of telling on my end because I'm just sitting here talking and can't see or hear any of you. But I hope it worked well, and I encourage you to be sure you please send us feedback on how well this worked, what didn't work, and should we try to do videos or do webinars on certain aspects of things, maybe throughout the month rather than waiting month to month, 30 days between meetings. So again, thank you all for participating. It's been my pleasure to be able to provide you this information. And for all of our members and all of our chapters and the Phoenix Real Estate Club, thanks for being part of us. If there's anything we can do for you, please don't hesitate to get in touch with us. I want to thank you for participating, and we look forward to hearing from you. Thank you. Good night.